When I talk about premature exits, I'm not talking about something small. I'm talking about the quiet leak in a trader's account that never makes a sound until the balance is gone. Most men don't go broke because they don't know how to enter a trade. They go broke because they don't know how to stay in one. They see a little profit, they feel a little relief, and they run like a scared clerk from a fire drill. Have you ever noticed how the market doesn't really move until after most traders have already taken themselves out of the game? I learned early that the tape does not reward impatience. It rewards sitting still. A stock will spend days doing nothing, weeks fooling you, and then it will move in a way that makes all that waiting worthwhile. But by then, most traders are already gone. They took 5 points and patted themselves on the back, while the stock went on to move 50. And they call that being smart. But tell me, is it smart to leave the table just when the cards turn in your favor? You see, the market is designed to make you uncomfortable right after you get in. If you buy right, the stock will hesitate. It may even dip a little. That's how it shakes out the weak hands. And if you sell short right, it will bounce and make you feel foolish. That's not a mistake. That's the market testing your nerve. The trader who understands this doesn't flinch. He knows his position was taken for a reason, based on what the chart and the tape told him. So why should a few hours of noise change his mind? Most premature exits come from fear, not from facts. A man sees green in his account, and he's afraid it will disappear. So he grabs it. But that fear has no respect for trend, no respect for volume, no respect for the line of least resistance. It only knows the last trade. And the last trade is the least important thing on the tape. Have you ever asked yourself why the biggest moves always seem to happen after you get out? When I was young in this business, I thought I was clever because I took profits quickly. I thought I was being cautious. But I was really just cutting off the very thing I was working for. A trend is not a gift that comes all at once. It pays you in installments. You collect the first few, and then if you have the patience, you collect the big ones. But if you stop showing up after the first check, don't be surprised when the real money goes to someone else. Look at any great move on a chart. It never goes straight up. It pulls back. It shakes. It makes little false turns. That's what creates doubt. That's what makes traders sell too soon. The man who rides the trend is not braver. He's just more disciplined. He lets the market tell him when he's wrong instead of letting his emotions do the talking. And that's the only voice you should be listening to. Can you really call it trading if you're letting your feelings run the operation? Premature exits also come from not knowing what you own. If you buy a stock without understanding its position in the general market, its trend, and its behavior, then of course you'll panic when it moves a little against you. But if you know it's in a strong uptrend, making higher highs and higher lows, why should a small pullback scare you? That's not danger. That's just breathing. Even the strongest stocks have to catch their breath before they run again. A man who exits too soon is usually a man who didn't have a plan to begin with. He bought because it looked good. He sold because he felt nervous. That's not speculation. That's gambling. When I take a position, I already know where I'm wrong and where I'm right. I know how much I'm willing to risk, and I know what kind of move I'm waiting for. So when the market wiggles, I don't flinch. I'm not there for wiggles. I'm there for trends. Are you trading the trend, or are you just reacting to every tick? The tape is like a river. You don't fight it. You float with it. If it's flowing up, you stay with it until it shows you it's done. If it's flowing down, you ride it until it stops. Getting out early is like stepping off a moving boat because you heard a splash. You may feel safe for a moment, but you've left the journey behind. And in this business, the journey is where the money is. One of the hardest things for a trader to learn is that being right is not the same as making money. You can be right about the direction and still lose because you didn't stay long enough. You caught the move but let go before it paid you. The market doesn't hand out prizes for accuracy. It pays for patience. And patience is not passive. It's an active decision to trust your work and let it play out. I've seen men catch the start of a bull market and sell in the first rally. They congratulate themselves and then watch in disbelief as the market goes on for months without them. They spend that time looking for another entry, but it never feels as good as the first one. And that's the real tragedy. They were in the right place at the right time, and they left because they couldn't stand to sit still. Do you know how rare it is to be right and stay right? Every time you exit a trade, you're making a statement about what you believe will happen next. If you sell a strong stock in a strong market, you're saying you think the trend is over. But have you really seen anything that proves that? Or are you just tired of holding? The tape does not care how tired you are. It only cares about supply and demand. And as long as demand is winning, the wise man stays put. There is a kind of loneliness in holding a winning trade. Everyone else is either out or telling you it's too high. You start to feel like the only fool left. But that's exactly where the money is made. At the point where doubt is loud and the trend is still strong. That's when the amateurs get out and the professionals settle in. Which one do you think you are when you feel that pressure? Taking quick profits is often just fear dressed up as discipline. That simple idea explains more losing accounts than most complicated indicators ever could. A trader sells a position as soon as it shows a little green, and he tells himself he is being careful. He tells himself he is protecting his capital. But if you look closer, what he is really doing is protecting his feelings. He is afraid the market will take back what it just gave him, so he grabs it and runs. That is not discipline. That is panic wearing a respectable suit. Real discipline comes from following your plan, not from bailing out the moment the trade becomes uncomfortable. When a stock starts to move in your favor, that is usually when the real test begins. The first few points of profit are easy. They come from the initial burst of momentum after you get in. But the real money comes later, when the stock keeps moving and the trend proves itself. That is the part most traders never see, because they are already out, congratulating themselves on a small win while the market is getting ready to make a big move without them. Fear is a powerful thing in trading because it feels logical. A trader thinks, I have something now, so I should lock it in. That sounds sensible. But the market does not reward what sounds sensible. It rewards what is aligned with the trend. If the chart is telling you the stock is in a strong upward move, selling just because you have a small profit makes no sense. You are stepping out of a moving train just because it picked up speed. And yet traders do this every day, all because fear whispers that what they have might disappear. The market is built to make you doubt yourself right after you are right. A stock breaks out, you buy it, and then it pauses. It may even dip a little. That pause is where fear shows up. Your profit shrinks, and suddenly you feel foolish for not selling sooner. So you sell often, right before the stock starts the next leg up. You call it being cautious, but in truth, you were just afraid to let the trade breathe. You wanted certainty in a business that never offers it. There is a big difference between managing risk and cutting off opportunity. Risk management is about knowing where you are wrong. It is about having a level on the chart that tells you the trade is no longer valid. Quick profit taking has nothing to do with that. It is not based on the chart or the trend. It is based on the size of your open profit and how it makes you feel. When you sell because you are scared to lose what you have, you are not following the market. You are following your emotions. Many traders think that taking profits quickly makes them professional. They like the idea of steady, small gains. It feels safe. But safety in trading is often an illusion. Small gains are easy to give back if you never allow your winners to grow. You can be right 6 times in a row and still lose money if the one time you are wrong costs more than all your small wins. The only way to balance that is to let your winners run when the market gives you the chance. And fear is the main thing that stops you from doing that. When you hold a winning trade, you are doing something very uncomfortable. You are allowing uncertainty to exist while money is on the line. Your account is fluctuating, your profit is moving up and down, and there is no guarantee it will keep going. That uncertainty is what most people cannot tolerate. So they end it by selling. They choose the certainty of a small win over the possibility of a larger one. It feels like discipline, but it is really just a desire to stop feeling uneasy. The market does not care how uneasy you feel. It only cares about buying and selling pressure. If buyers are still in control, the trend is still alive. Your job is to stay with it until the evidence changes. But fear does not wait for evidence. Fear reacts to every little tick. It sees a small pullback and imagines a full reversal. It sees a pause and imagines the end of the move. And so the trader sells, often right before the trend resumes. A trader who takes quick profits is often trying to avoid regret. He does not want to look back and think, I should have sold, so he sells early just in case. But regret works both ways. There is also the regret of selling too soon and watching the stock run without you. That kind of regret is quiet but deep. It teaches you that you did not really trust your analysis. You were right, but you did not have the courage to stay right. Fear also comes from not having a clear idea of what you are trading. If you do not know whether you are in a short-term swing or a longer-term trend, every move feels dangerous. A small pullback feels like a threat instead of a normal part of the pattern. So you take profits because you do not have a bigger picture to lean on. When you trade with a clear understanding of the trend, you can sit through small fluctuations without panicking, because you know they do not change the larger story. The habit of taking quick profits trains your mind to think small. You start to expect small moves, so you never prepare for big ones. When a real trend shows up, you treat it like just another little trade. You grab a few points and move on, missing the opportunity to let that one move do the heavy lifting for your account. Over time, this keeps you stuck in a cycle of constant effort and limited reward. The big money lives in the middle of the trend, not at the first bounce. And that is something most traders understand in theory, but almost never in practice. They talk about riding trends, but they behave like bargain hunters, always trying to grab something early and get out fast. They buy the first pop, they sell the first pullback, and then they wonder why their account never seems to grow in a meaningful way. The truth is, the market does not pay you for being early or for being quick. It pays you for staying in harmony with the main move long enough for it to matter. Every major trend begins quietly. A stock breaks out of a base, volume picks up, and price starts to move. The first bounce off that breakout is exciting because it feels like you caught something. That first bounce gives you a small profit and a burst of confidence. But that is not where fortunes are made. That is just the invitation. The real opportunity begins when the trend starts to establish itself with higher highs and higher lows, when pullbacks become shallow and buyers keep stepping in. That is the middle of the trend, and that is where the big money starts to accumulate. Most traders never get there because they sell at the first sign of success. They see a few points of profit, and they take it, telling themselves they can always get back in. But the market does not always give you a second invitation. Strong trends do not like to look back. They move, they pause, and then they move again, often leaving the early sellers behind. By the time those traders realize what is happening, the stock is much higher and feels too expensive to buy, so they miss the whole move. The middle of the trend is not glamorous. It is often boring and uncomfortable. The stock is no longer cheap, so it does not feel like a bargain. At the same time, it is not yet wildly profitable, so it does not feel like a victory. You are just sitting there, watching price wiggle back and forth while the trend slowly does its work. That is the place where patience is tested. That is the place where doubt creeps in, and that is why so few traders stay there long enough to be rewarded. When you hold through the middle of a trend, you are not relying on hope. You are relying on structure. The chart is telling you that buyers are still in control. Each pullback is met with support. Each rally pushes to new highs. As long as that pattern holds, the trend is alive. But most traders do not want to wait for the pattern to break. They want to leave while everything still looks good, because leaving while things look good feels safe. Staying while things look good feels risky, even though it is actually the smartest thing to do. The first bounce in a move is often driven by short-term traders and early buyers. They create the initial momentum. But the middle of the trend is driven by bigger money. Institutions, funds, and longer-term participants start to build positions. They do not rush in and out. They accumulate over time. Their buying creates a steady upward pressure that lasts much longer than the first pop. If you want to be on the side of real money, you have to be willing to sit through that accumulation phase instead of jumping out at the first sign of profit. There is also a psychological trap in trying to catch the first bounce. When you sell there, you feel clever. You feel like you outsmarted the market. But that feeling is short-lived. Soon you see the stock continue to rise and your cleverness turns into frustration. You start chasing or you sit on the sidelines, watching a move you were once part of. That cycle repeats over and over for traders who never learn that the real opportunity was not the first bounce, but the long stretch that followed it. The middle of the trend is where consistency is built. One strong trend held properly can do more for an account than a dozen small trades. It smooths out the equity curve. It gives you room to make mistakes elsewhere. But you only get that benefit if you stay in the trade. If you keep jumping out early, you turn every trend into a short-term scalp, and you never allow any position to grow into something meaningful. Holding the middle of a trend requires you to accept that you will not sell at the top. You will give back some profit when the trend finally ends. That is the price you pay for catching the big part of the move. Many traders cannot accept that. They want to be perfect. They want to sell at the high and buy at the low. But perfection is not how money is made in the market. Money is made by being right enough, for long enough, to capture the bulk of the move. The market will always try to convince you that the move is over long before it actually is. A sharp pullback, a bad news headline, a day of heavy selling. All of these things are designed to shake out weak hands. In a healthy trend, these events are just noise. They are opportunities for bigger players to add to their positions. But to the trader, who is focused only on the first bounce, they look like danger. So he exits and misses the continuation that follows. There is also a deeper lesson here about wealth building. Real wealth is not built from quick wins. It is built from sustained growth. A business grows by expanding its core operations, not by flipping small deals. A trader grows his account by staying with strong trends, not by hopping in and out for small profits. The middle of the trend is where compounding happens. Each new high builds on the last. Each pullback creates a new base for the next move. Over time, that steady progress adds up to something significant. When you learn to value the middle of the trend, your whole approach to trading changes. You stop obsessing over perfect entries. You stop worrying about small fluctuations. You focus instead on the overall direction and strength of the move. You let the market do the heavy lifting instead of trying to micromanage every tick. And that shift is what separates traders who are always busy from traders who are actually profitable. The big money does not come from being constantly active. It comes from being correctly positioned when the market makes its move. That means entering a trend when it is starting to form and then staying with it through its development. It means ignoring the temptation to take small profits and instead waiting for the trend to show signs of exhaustion. That patience is what allows a trader to catch the heart of the move, the long, powerful stretch where price travels far and fast. A trade should end when the chart changes, not when your nerves do, and that simple rule would save most traders from their own worst habits. The market speaks through price, volume, and structure, not through the flutter in your stomach or the voice in your head that starts to whisper when a little profit is on the line. Yet most traders listen to that inner voice far more than they listen to the chart. They see a small pullback and they feel fear. They see a quick spike and they feel greed. And they let those feelings decide when to get out, even though nothing on the chart has actually changed. When you enter a trade, you are making a bet on a pattern. You are saying that this stock is likely to move in a certain direction because of what you see in its behavior. That behavior is recorded in the chart. It shows you trends, support, resistance, momentum, and the balance between buyers and sellers. As long as that behavior remains intact, the reason for the trade still exists. Ending the trade just because you feel uncomfortable is like changing your mind about the weather because the wind picked up for a moment. Your nerves react to short-term fluctuations. The chart reflects the underlying reality of the market. Those two things are not the same. A stock in a strong uptrend will have down days. It will have sharp pullbacks. It will have moments that make you question your decision. None of that means the trend is over. But your nerves do not know the difference between a normal pullback and a real reversal. They only know that money is on the line, and they want to protect it. That is why so many traders sell right before the next big push higher. The chart never told them to sell. The trend was still intact. Support was still holding. Volume was still healthy. But their nerves could not stand the uncertainty, so they exited. They then watch from the sidelines as the stock continues to move in the direction they originally expected, and they feel a different kind of pain, the pain of knowing they were right but did not have the discipline to stay right. A chart gives you objective information. It does not care about your account balance or your recent trades. It shows you what the market is doing. When a trend breaks, you will see it. You will see lower highs in an uptrend. You will see support give way. You will see heavy volume in the opposite direction. Those are signals that the trade is no longer valid. Those are reasons to get out. But most traders never wait for those signals. They leave at the first sign of discomfort, long before the market has actually changed its mind. One of the reasons this happens is that traders confuse volatility with danger. A stock moving up and down can feel threatening, especially when you have an open profit. But volatility is not the enemy. It is part of how trends develop. A smooth, straight line rarely lasts. Trends move in waves. They surge, they pull back, and they surge again. Those pullbacks are where weak hands get shaken out and strong hands take control. If you sell every time a wave turns downward for a moment, you will never experience the full power of the move. Another reason traders let their nerves decide is that they have not clearly defined what would make them wrong. Before you enter a trade, you should know what the chart would have to do to prove your idea incorrect. That might be a break of support, a failure to hold a key moving average, or a shift in momentum. Whatever it is, that level is your line in the sand. As long as the price stays on the right side of that line, the trade is still alive. Your nerves might be screaming, but the chart is calm, and the chart is the one that matters. When you exit based on nerves, you are essentially saying that your feelings are more reliable than the market itself. That is a dangerous belief. Feelings are shaped by recent outcomes, by fear of loss, and by the desire for comfort. They are not shaped by supply and demand. The chart, on the other hand, is nothing but supply and demand made visible. It tells you where buyers are stepping in and where sellers are taking control. Ignoring that information in favor of your emotions is like turning off your navigation system because you do not like the sound of the voice. There is also a deeper cost to letting nerves run your trades. It trains you to distrust yourself. Every time you exit early and watch the market go on without you, you reinforce the idea that you cannot hold a position. You become more anxious in the next trade. You take profits even faster. The cycle feeds itself. Breaking that cycle requires a commitment to let the chart, not your fear, be the final judge. This does not mean you should ignore risk. It means you should define risk properly. Risk is not a temporary dip in your profit. Risk is a change in the pattern you are trading. If you bought a stock because it was making higher highs and higher lows, then the risk is that it stops doing that. A single red candle does not change that. A normal pullback does not change that. But a break of the trend does. Learning to tell the difference is what separates disciplined traders from nervous ones. There will always be moments in a trade where you feel like you should get out. That is normal. Even the best trades feel uncomfortable at times. The market has a way of testing your resolve. It will move just enough against you to make you doubt, and then it will move in your favor again. If you bail out at the first test, you will never pass the exam. The chart will keep offering the same lesson until you learn it. Over time, if you stick to this rule, something changes inside you. You start to feel less reactive. You stop watching every tick. You trust the structure of the trade. You let the market do what it does. That does not mean you are careless. It means you are focused on what actually matters. When the chart finally does change, when the trend truly breaks, you will be ready to act, because that decision will be based on evidence, not emotion. Most traders exit early because they never truly trusted their entry, and that lack of trust is something you can see in every nervous click of the mouse and every hurried decision to lock in a small profit. A trader who believes in his analysis does not feel the same urge to escape at the first sign of uncertainty. He expects uncertainty. He knows the market will move back and forth, and he has already accepted that before he ever puts on the trade. The trader who does not trust his entry, on the other hand, is always waiting for a reason to get out, because deep down he is not convinced he belongs in the position in the first place. When you enter a trade without real conviction, every tick feels like a verdict. A small move against you feels like proof you were wrong. A small move in your favor feels like a chance to get away before you are exposed. That is not how a confident trader behaves. Confidence does not mean arrogance or recklessness. It means you have done the work. You have studied the chart, the trend, the volume, the broader market. You know why you are in the trade. So when price wiggles, you do not panic, because nothing has happened to invalidate your idea. Many traders enter trades for weak reasons. They see a stock moving and they jump in. They hear a tip. They notice a breakout but do not really understand the context. These shallow entries create fragile positions. When you are not sure why you bought something, you cannot be sure when to hold it. So you default to the easiest decision, which is to sell as soon as you have a little profit or as soon as you feel uneasy. That is not strategy. That is uncertainty trying to protect itself. Trusting your entry starts long before you place the trade. It starts with preparation. When you take the time to identify a clear pattern, a strong trend, and a logical point of entry, you build a foundation for patience. You know what you are trading. You know what would have to happen for the trade to be wrong. That knowledge gives you something solid to lean on when the market starts to test you. Without it, you are standing on emotion, and emotion is a shaky place to stand. A trader who trusts his entry does not need constant reassurance from the market. He does not need the price to go straight up to feel comfortable. He knows that even the best trades will pull back, consolidate, and look uncertain for a while. That is normal behavior, not a warning sign. But a trader who entered without conviction sees those same movements as threats. He is always asking himself if he made a mistake, and that question leads him straight to the sell button. There is also the issue of time. Good trades often take longer than people expect. A trend may develop over weeks or months, not minutes or hours. If you entered a trade thinking you were going to get a quick payoff, you will get restless when it does not happen. Restlessness turns into doubt, and doubt turns into early exits. But if you entered with a longer-term view, based on a strong pattern, you are prepared to let the trade unfold. You are not in a hurry, because you know the move you are looking for cannot happen in a rush. Trust is built by consistency. When you follow the same rules over and over, you start to see how they play out. You see that many trades look shaky before they become profitable. You see that trends often continue longer than seems reasonable. Those experiences slowly teach you that your method works, even when it feels uncomfortable. That is how trust grows. Without that history, every trade feels like a gamble, and gamblers always want to cash out early. Most premature exits are really just an attempt to avoid being wrong. If you do not fully trust your entry, you are afraid that the market will expose you, so you leave before it has a chance to do so. You take a small profit or a small loss and tell yourself you were smart. But in reality, you never gave the trade a chance to show what it could do. You protected your ego, not your account. A trader who trusts his entry is willing to let the market prove him right or wrong. He does not try to control the outcome. He knows he has an edge, and he is willing to let that edge play out over time. That means sitting through drawdowns, ignoring noise, and resisting the urge to micromanage the position. It is not easy, but it is the only way to allow a good trade to become a great one. When you look back at your own history, you will often see that your best trades were the ones that felt uncomfortable at first. They wobbled. They made you question yourself. But because you stayed, they eventually paid off. The trades you exited early may have looked safe at the time, but they often went on to become much bigger moves. That pattern is not an accident. It is a reflection of whether you trusted your entry or not.